Hello, this is David Harper of Bionic Turtle, and what is a securitization? First, a securitization is a type of structured finance or a subclass of structured finance. So there can be other structured finances which are not securitizations. In regard to a securitization, we like to say there are three key ingredients. The first is that there is a pooling of credit-sensitive assets. This pooling of assets can be either cash-based or synthetically. Cash-based means the credit-sensitive assets are purchased into a pool. Synthetic, for example, could refer to a synthetic CDO, collateralized debt obligation, where the assets are originated synthetically by way of issuing credit default swaps. Why does the pooling matter? Because in pooling the assets we introduce diversification, and this allows the senior tranches issued to investors to enjoy a higher credit quality than the average obligor in the pool. The second key ingredient is the transfer or delinking of credit risk away from the originator to the third party or to the special purpose vehicle. So this transfer of credit risk, this separation, is a key ingredient in the securitization, and it's not just up to the whim of the originator. Rather, there are rules around whether there has been a true transfer of credit risk or what is called a true sale in the accounting rules that govern the transfer here, and that is FAS 140. In FAS 140, there are 4 criteria that must be met in order for the originator to effect a clean break or true sale away from the originator's balance sheet and into the special purpose entity or vehicle. Why does the originator want to meet these criteria? Primarily because of so-called derecognition. If the originator meets these criteria and effects a true sale, then the originator does not need to consolidate the credit-sensitive assets on its balance sheet. So there are 4 key criteria, but you'll notice I've isolated on one. The first is that the special purpose entity is bankruptcy remote. So there's distance between the originator and the special purpose vehicle. The second is that the special purpose vehicle has limited activities that have been predetermined or require an approval of a majority of the interest holders. The third, and the criteria that really captures the essence of the FAS 140 and the true sale criteria, is that the originator surrenders control or transfers control to the third party, again the special purpose vehicle. It is the surrender of control that captures the essence of the clean break criteria and allows the originator to not consolidate the assets, to remove them from the balance sheet. Fourth, the special purpose entity or vehicle retains the right to pledge, resell, or exchange the assets. And hopefully you can see this is closely related to the idea that the originator has surrendered this control. So 2 things I would say about FAS 140. The first is that on September 15th, just about a week ago, FASB issued an exposure draft to amend the FAS 140 rules. So these rules on the margin are certainly subject to change. The second, and this is more important for FRM candidates, and this relates to the qualified special purpose entity. Under the current FAS 140, there are many securitizations that achieve the derecognition by use of this exception or loophole, if you're cynical, that allows the originator to derecognize if they meet the criteria for a qualified special purpose entity. So there are different criteria. This is allowed for these securitizations. However, FASB has proposed to eliminate it. Therefore, for the FRM, I do not expect this to be quizzed. So we've looked at the 4 criteria that constitute the true sale under FAS 140, and that true sale speaks to the second key ingredient, which is the transfer of credit risk from the originator to the special purpose entity. The third key ingredient is the tranching of the liabilities, and I've got a diagram for that. But we'll note here there's three key ingredients, and I like to think of them as the assets on the left, the liabilities on the right, that's a balance sheet perspective, and the transfer in the middle. So what I mean is, if we look at a highly simplified diagram of a securitization, we have credit-sensitive assets on the left that are generating cash flows. These could be trade receivables or mortgage loans, and they are pooled and transferred into the special purpose vehicle. So these are the assets on the left, and they are pooled. And then on the right, we have the liabilities, which are the notes issued to the investors. And these notes are tranched or separated into so-called loss layers. But like a balance sheet perspective, what's on the left has to match what's on the right. So the market value, let's just say, for example, $400 million in total credit-sensitive assets, needs to equal the total notional or market value of the tranched liabilities issued to investors on the right. In this case, the $400 million in credit-sensitive assets has been separated simplistically into 4 tranches of $100 million each. And the 400 is conserved or preserved. And tomorrow I'll show you further this conservation extends beyond the value and even to the risk characteristics. So if this is like a pie on the left, the total pie is going to be preserved in terms of value and risk. What's different is it's going to be sliced into these tranches, or wedges if you like, and they will each have different characteristics. A senior, for example, called A, which may have several layers, a mezzanine, which may have several layers and could be called B, and finally at the bottom, the equity tranche. So tomorrow I'll look at this rule of the conservation of value and risk between the assets on the left and the tranched liabilities on the right. But I hope this was helpful in terms of the 3 key ingredients for a securitization: a pooling of the credit-sensitive assets, a transfer of credit risk from the originator to the special purpose entity or vehicle, and that implies legal, as in bankruptcy remote, and accounting distance or separation, and finally the tranching of liabilities, and so such that we will preserve the total value and risk of the credit-sensitive asset pools, but we will create these notes that have different characteristics individually. This is David Harper of the Bionic Turtle. Thanks for your time.